right, everybody. Welcome to the webinar today. And thank you so much for being here with us. My name is Molly Yakubian. I am the managing partner and CEO of Vector. Vector is a service-first fund admin for closed-end investment funds. We work predominantly in the venture capital and private equity space with a specific focus on venture and emerging managers in venture. Vector has the privilege of working with just under 70 clients, many of whom are first-time fund managers. In that work that we do with clients, we are often involved in the earliest stages of fundraising all the way to the first close and beyond. And so we work very frequently with clients to help them navigate the complexities and needs that come with launching and standing up funds for the first time, which is what this webinar series has been focused on. This is the third webinar in our Essential Fund Launch webinar series. We first met with DLA Piper to talk about fund formation. We had a session with the founders of Passthrough last week on the state of fundraising, both of which are recorded and available and will be, both are online, and then we also will include the links to those prior sessions in the follow-up to this webinar. Today, we are sitting down again with some more from the Passthrough team to discuss AML obligations for venture capital managers, a topic that has been a big point of discussion recently, particularly since the beginning of the year. We have structured today's webinar with a series of questions that I'll be running through with the team here from Passthrough, but there is a question feature within this platform, so please feel free to use it. The questions are confidential, and we will go through any questions that are submitted live in the last 15 minutes of the session here. So with that, I am joined today by Julius Leiman-Carbia. Julius has over 30 years of experience in the securities industry and is currently the Chief Legal Officer and Privacy Officer of Passthrough. Ricardo Serrano is a financial compliance analyst at Passthrough, bringing a wealth of legal knowledge and expertise to the organization in his role. And Justis Midura is Passthrough's product manager with a focus on their KYC AML product specifically. So a wonderful group here today. With that, Julius, maybe you can just give a bit more overview of Passthrough, as well as a bit more on your background, and then we can kick things off from there.
Yeah, sure. Thank you, Molly, and hello, everybody. So Passthrough is a technology company that develops a front-end software in order to facilitate the participation in private funds by automating the sub-doc process. And as part of that, we collect information, and we're able to leverage that information in order to provide a service that we call KYC AML that enables us to provide risk advice to funds regarding the screening, regarding the sanction screening associated with the names and the information of each one of the investors for the funds. And with respect to me, I have a lot of experience in financial crimes, which includes BSA, AML, as well as sanctions, having been the global head of sanctions for MUFG, which is a Japanese bank, and it is in fact the 10th largest bank in the world, right there in size, similar to JP Morgan.
Great, thanks so much. I think we will kick things off here with a poll for the group. How are you currently conducting AML checks for your fund, for those of you fund managers here? Would love to know. And while you are filling out that poll, maybe Julius, you can kick us off with very simply, what is AML and KYC?
So AML stands for anti-money laundering. KYC stands for know your customers. And those are just components of a broader discipline called financial crimes. I think we keep on talking about KYC AML, but interestingly enough, KYC, AML and KYC do not apply to investment advisors. However, sanctions applies to everybody, whether you are a registered investment advisor or you are otherwise exempt. In fact, sanctions apply to all of us. I mean, the best example is Cuban cigars. We can't buy Cuban cigars, so it applies to us individually. But the thing is that the reason why KYC AML has become such a sort of important term is because the banks who are themselves subject to KYC AML obligations have started to apply the obligations to clients who run and introduce investors into the bank process. And so initially, the bank regulators only applied the requirements just to the bank and the bank business, but as they realized that funds as well as other organizations introduce risk into the bank itself, they have started to sort of cascade the obligation on KYC AML beyond just their internal operations into the operations of their clients, such as funds that actually clear through them or broker dealers that clear through them. And so they apply KYC AML, they apply sanctions, and they apply other rules that also are related to financial crimes, but that are really less of an issue and not as relevant to our discussion today.
Thank you. And as a follow-up there, the terms themselves, AML and KYC, could you maybe just speak to the difference between those and sort of how they are related to one another as it pertains specifically to fund managers?
Yeah, so KYC along with CDD are sort of at the top level. So KYC means know your customer, CDD is customer due diligence, and so they both relate to different ways of understanding the relationship with your customers. KYC is about knowing who you're dealing with, and CDD is understanding the ownership relationship that the particular customer has in connection with the investor per se. So that the first one has been an obligation for banks for a long time. The second one has been an obligation for the last 5 to 7 years, since the Fed has imposed an obligation to understand sort of the beneficial ownership structure of the investors, of the customers, or people who are participating in investments. And then AML, it's just more directed to understanding how is it that whether the client itself is using the bank or using any other financial organization to launder money, meaning money proceeds from illegal activities, and using the bank to clean that money so it looks like it did not relate to the criminal activity from where it was derived.
Got it. Thanks so much for that. And so, practically speaking, for fund managers, what are the primary objectives and requirements really for AML and KYC compliance for those managers in venture capital specifically?
So I mean, if anyone wants to, if Justis or Ricardo want to talk a little bit about this, but I mean, this is what we do, which is we facilitate the process of getting to know your customer. So we actually, because we have so much information about the client, we are able to use that information for many purposes that are beneficial to the fund, including understanding whether a person is the person they say they are, because we actually have, for example, we have the driver's license, ability to obtain a copy of the driver's license. If it's a trust, we verify that the trust exists. So in doing that, we are actually facilitating for the fund the ability to certify to their bank that they are in compliance with KYC. We also have a functionality that enables us to understand the beneficial ownership structure and identify the different members of the beneficial ownership structure, so that the funds can also certify to their banks that they are complying with the beneficial ownership rules and the CDD obligations.
Yeah, Ricardo, maybe you can expand on that a bit. I mean, I think what we're hearing is that it's really the mandates from the banks themselves that are necessitating this in the VC space more than we've seen historically. However, I know that there are other reasons why venture capital and other alternative investment managers should be thinking about having and implementing more robust AML KYC policies, even if they are with a bank that is not specifically requiring a particular set of policies. Ricardo, maybe you can speak to some of the other reasons or objectives of having these types of policies and procedures for venture capital funds.
Yes, of course. I'm glad to be here with you guys today. Hello to everybody. So basically, Main objectives of financial security in the VC space, we could argue them out to be three main objectives. So preventing money laundering, echoing what Julius was just talking about, protecting the firm's reputation and financial interests would be another main objective that we can talk about, and ensuring regulatory compliance. Basically, by adhering to the guidelines in the specific instance of preventing money laundering, VC firms can help identify, detect, or even prevent any instance of money laundering, preventing proceeds from criminal or illicit activity, how Julius was talking about earlier. Another objective that we want is to protect reputation and financial interests. So compliance with the guidelines-based practices will protect VC firms from reputational and financial harm that could arise from doing business with illicit entities. And also, we want to maintain an objective of regulatory compliance with the actual landscape that we have today. And echoing to another point that Julius was making earlier, even though the acts don't specifically require VC firms to have formal AML programs, through the banks requiring VC firms and private equity firms and other clients to adhere with these guidelines, it's best practices that are essential to avoid any strict liability in case of any involvement with wrong persons or entities that are having issues. Yes, Julius.
Oh, no, I was just agreeing with you, but I think, well, you make a great point. I mean, it, the truth is that not all banks are requiring it at this point, right? So some banks are, especially those banks that have had some issues themselves with these rules. But what is important is that what is very important is that the trend is actually moving in the direction of requiring KYC, AML for everybody, including advisors. We haven't seen the rules, but the SEC kind of has been moving in that direction. And I think that all of this is being prompted and pushed by Treasury as well as other bank regulators. And why is this important? Well, look, what you do not want to be in a situation of what regulators call remediation, which means that you've closed your fund and now you are in the process. You're investing, and then the rules change, and your bank says, well, you cannot wire money to clients because you have not completed your KYC ML. And then at that point, and I've seen this happen already, then you then have to restart the process and get a lot of information from clients that at this point clients are less interested in giving you. Clearly, if you're going to give them money, they probably are very interested in giving you all the information they need to give you. But it's not always the case that these situations are caught. For example, one situation we saw was in the distribution of shares, where a financial organization said to the fund, "Well, you can't distribute. You cannot distribute the shares because you have not done KYC. So you need to remediate this." And this was difficult. We actually were able to help the client, and I think client is very happy because actually he was able to resolve this problem. But it's never an easier process to sort of try to fix things in hindsight that it is to do it at the time when everybody is providing you information and everybody's eager to close.
Yeah, certainly. And one thing that we frequently see come up is that managers, in particular, first-time fund managers, are going through the closing process, not as accustomed and familiar with the AML KYC processes, and may get pushback from investors that say, "Hey, I've never had to do this before. Why do you need so much information from me?" So I think it might be helpful for Julius or Justice Ricardo, whomever, just to speak to how much has evolved in this specifically for the private market space and in what time period, because that is a frequent source of pushback and sometimes confusion for emerging fund managers.
I think, Justice, you have a lot of experience in this area, given you're the first call.
Yeah. So I would say it's evolved a lot over the past couple of years, Molly. There's some clear and obvious drivers. One would be the sort of geopolitical environment we find ourselves in, with a lot of sanctions being sort of issued daily, and people needing to respond to that, and needing to have an infrastructure that allows you to respond to that quickly, which sort of necessitates the kind of thing that we're offering, but also just the broader sort of technology ecosystem out there for KYC and AML activities. And then more recently, with the collapse of a couple of bigger banks sort of in the venture space, there's been a need to move towards larger banks like JP Morgan that have, don't want to say stricter requirements, but they're definitely passing those requirements on to their clients. I'd say between those two things, and then just sort of the U.S. government being more on top of this lately, those would be the biggest drivers and the biggest developments in the industry.
Yeah,
and Justice, it's interesting to note that we get a lot of those complaints that Molly was referring to. I mean, how many times do clients say, "I've never had to do this before. Why am I doing it again?" And it's important to note KYC is a risk-based approach, right? And for those who are lawyers in this process, we all know that our profession is really about providing therapy to our clients, and so sort of working with them in helping them understand how these process works. So one of the things that we do, and Ricardo is very good about this, is we point out to the rules. We said, look, here is what the rule says, and here's what you're required to provide. This enables and facilitates the GP. It gives the GP the tools that the GP needs to be able to have a conversation with the LP and say, look, it's not that we're trying to be difficult, is that there is a rule here that says this. Now, our structure is such that we are not responsible for preventing an investor from participating. What we do is we give the compliance officer a rating, and we have a conversation with the compliance officer. And there are cases where the compliance officer has had a client for many years, and they know the client very well, and they understand that the client does not want to provide a trust document or a driver's license or their children's driver's license. And they are willing to accept that risk because they know the client. I don't recommend doing this all the time. And I recommend that people, if they make that decision, they document this appropriately, so that if the bank comes back in the form of an audit, they can document it. But these things happen, and they should be exceptions. But in general, we get a lot of those clients who are saying, I've never had to do this. And we try to work through the process with the GP to help them have that difficult conversation with their client, with their investor.
Yeah, and I want to come back to that point, because that's definitely another point that can cause a lot of questions around. Okay, there's a hit, whether there's a positive result for an adverse media check or an AML search or a politically exposed person. Now what? And so I'd like to come back to that a little bit later. But before you get to that point, you first need to conduct the diligence on the verification of the investor themselves, right? Before you can even run the search. So Justis, maybe you can speak to how VC and PE firms are typically conducting that diligence around the verification of the investor identity. So that's more on the KYC side.
Yeah, definitely. And I think like the first thing that I want to point out is that I'm not even aware if VC firms have been doing this outside of maybe the biggest ones historically, like Andreessen Horowitz or Sequoia or something like that. But the way that a private equity firm would, and the reason that they do, of course, is reputational risk at this point in time, is basically when an investor is at the point that they're subscribing to a fund. Frequently, what's sent out with the subscription document is what is referred to as the KYC checklist. It lists out the types of entities that could be admitted into the fund and what the various document requirements are, and data point requirements. And the process looks something like a representative from the investor or the investor themselves, in the case that they're an individual, referring to this checklist, trying to figure out, okay, if we use an example where, let's say you have an LLC, it looks like the requirements for an LLC are, say, an operating agreement or articles of association. But then also the fund needs to know who the managers are or any directors, or basically two pillars: who controls this entity and who owns it. And in the case that, and just to take a sort of more complicated example, in the case that the owners of the entity are other entities themselves, you can see that this process becomes sort of an iterative process where person submits documents, fund reviews the documents, so on and so forth, until eventually the individuals behind this investor are identified. Once that process is over, the fund will then take basically all of the names that make up the beneficial ownership structure, from the investing entity all the way down to the beneficial owners, and run searches in a third party. And I guess like some of the biggest names out there are probably RDC or WorldCheck, softwares like that. And then like run the searches and see what hits come back across various things like sanctions lists or political exposure lists, fitness and probity, or even adverse media, which I know we're probably going to touch on a bit later. And then it's an act of comparing the data that was submitted from the investor and the documentations that you know to be real with the data that was returned from these searches to figure out, are any of these true positives or any of them false positives. And so sort of the status quo, so to speak, is this very onerous and like time-consuming process that can be challenging.
Yes, particularly when there are entities involved. Ricardo, maybe you can speak to what some of those challenges are when onboarding investors into a venture capital fund associated with these processes that Justis just described.
Yeah, yes, of course. One of the biggest challenges that we face, maybe echoing a little bit with what Justis and Julius were talking about earlier, was trying to figure out the ultimate beneficial structure or the ownership structure of the investing entity. If it's a natural person, it's way more straightforward, right? You have a government ID, you have a proof of address, or all the documents that help you establish identification. But when we have an entity and we have this iterative process that Justis was just talking about, it becomes a situation that we have to go down the ownership structure until we find those ultimate beneficial owners that are the ones that are the controllers or the owners of the investing entity. And going through that process of finding those documents, getting to all the requirements, going through all of the formation documents of the entities that could be in that structure are one of the biggest challenges. And that takes me to my second challenge, or the second point, which is when we have all of these document requirements and we have all of these specific asks for investors, when is the best time to actually ask for all of these documents and figure out all of these requirements? And that brings me to the issue of closing. So we usually in this area would want to hold a best practice of asking for documentation before closing, in order to not be in the situation that Julius was talking about earlier of remediation, having to deal and mitigate risks after accepting an investor into a close. And that's where I guess that our tool becomes really helpful, because we create an opening for fund managers to be able to ask for all of these processes and documentation before closing, and be able to go through the KYC process and then accept or not accept that risk before closing. Although it's a process that it certainly in some cases has happened after closing, it becomes a challenge to go back to the investors and ask for all the required documentation, specifically when it's a really onerous ownership structure after closing, once all the process of onboarding has been completed. I don't know if Julius wants to add something to that.
No, I think you've captured it correctly. This is part of what I was describing before. I mean, you want to get this done up front. Even I'd say, you know, even if your bank is not requiring it, it's you definitely have to do sanctions, without a doubt, because that always apply. But even if the bank is not requiring you KYC, AML, I think it's good practice to do it, mostly because I think in the next the next 2 to 5 years, we're going to have a requirement on investment advisors to comply with KYC AML. And keep in mind that this requirement is probably going to go to advisors, whether they're registered or not, or whether they are exempt, because these are going to be, there's a good likelihood that these rules are going to come from Treasury itself. And Treasury has authority over all financial organizations, whether they are investment advisors or whether they're registered investment advisors or not.
Yeah, Ricardo, could you also perhaps touch on how do any of these complexities change or processes differ if you're dealing with international investors coming into your fund?
Yes, of course. So it all depends what our client and the base of our client specifically is, right? Like if we have a fund from the jurisdiction of the United States and we're bringing some international foreign investors into that fund, we need to comply with the regulations specifically from FinCEN and all of these other big regulators that we have here in this jurisdiction. If we have a fund from a different jurisdiction, then we have to comply with the regulations of that jurisdiction specifically. But specifically, when we are dealing with a US-based fund that we're trying to bring in foreign investors, then we need to make sure that all of the documentation that we are being provided from all of these foreign investors is the documentation that we actually need to complete the process of identifying the customer, and specifically the overarching thing that we need to do is to identify the ultimate beneficial owner of the entity that's trying to invest. So first, we're trying to figure out that the documents that we are being provided comply with U.S. jurisdiction. Second, we're trying to understand what the ownership structure of that foreign entity is. And then we go to an extra step to obviously verify all of those entities or individuals with a different list, including international lists that are there.
Yeah, and maybe one thing just to add here, Molly, for a lot of the folks on the call is that like the jurisdictional differences are quite substantial. In other words, like doing KYC in the United States is honestly simple in comparison to doing KYC in, say, the Cayman Islands. And in fact, like one thing that a lot of folks I would hope would want to know is that you probably want somebody on the ground in that jurisdiction helping you out, especially in a place like the Cayman Islands, where the ownership thresholds are much more conservative than the United States for what would constitute beneficial ownership, but also for what processes need to happen in order for a document to be considered certified, which is not a requirement in the United States. So things to think about if you're opening your fund and you're considering, whether or not to accept foreign investors and where to domicile a fund.
Yeah, I think Cayman is definitely worth mentioning, particularly where many funds will set up master feeder structures that have an onshore and an offshore. The AML requirements are significantly more burdensome in terms of the need to actually designate an AML compliance officer among all of the other items that Justis just mentioned. Maybe just switching gears a little bit, Julius, should firms also be doing adverse media searches?
That's a difficult question.
OFAC check?
So there's no obligation to do adverse media, right? And candidly, it's really difficult to do adverse media because the amount of false positives that are generated is enormous. We can do adverse media. We also shortcut our adverse media through lists. So we run names through lists, and it gives us a sense of whether there would be sort of a proxy for adverse media, for example, organized crime, or activity that it's connected with, that with organized with criminal activity that puts someone on the list. It is a good practice to understand who you're dealing with, and adverse media will give you a better sense as to whether you're dealing with someone who may be a criminal and who's trying to launder money through you. But in my experience, and I've been in charge of several financial intelligence units. I find adverse media to be very difficult to manage as a process, and still requires a large number of human beings to be able to do it correctly. So the process of shortcutting it by using lists, I think, is very helpful, and it gives you a higher degree of risk tolerance to be able to rely on without having to do full adverse media. But if necessary, sometimes Mike will ask you to do it, and it's very human capital intense.
So the recommendation is to essentially take a risk-based approach as it pertains to adverse media searches based off of the KYC process you've gone through.
There you go. Using a list is probably the better way. Yes.
Got it. Ricardo, any recent, I know we touched on this a little bit in the beginning, but perhaps just to dive in a little bit deeper, what are the recent regulatory changes that venture capital professionals should be aware of as it pertains to AML and KYC?
Sure. One thing to know, I think Justis and Julius were also talking about it earlier, is the fast pace in which all of these regulations are implemented and changed. And especially in the last 2 to 5 years, we've had an uptick in the implementation and the enforcement of these regulations. One thing that comes to mind would be the beneficial ownership information reporting regulation that came in from FinCEN, which is effective January 1st of 2024. So we're still a little bit preemptive in that approach. So basically, it's trying to rephrase what we talked about earlier. It's the government trying to go into those beneficial ownership structures and creating more guidelines and more specific ways in which corporations and other entities, limited liability companies or similar entities, need to report directly to FinCEN their beneficial ownership structures, and the ways and the procedures and the processes that they would need to go through, including the documentation that we need to provide in order to accurately represent those beneficial ownership and report those beneficial owners directly to FinCEN. As Julius was saying earlier, this is the trend of the regulatory landscape to be more transparent directly with the regulators. So we see regulations like this come up every year, every couple of months, trying to be a little bit more stringent in the way that we deal with the investing landscape.
I think most people in this call are very aware that the current SEC is very proactive in terms of developing new regulations. So I don't think it would be a surprise to anyone if we wake up one morning and there is a proposal to extend KYC to investment advisors. That would not surprise me. But I think it's important to know that the sort of the political landscape is changing, right? So we have the elephant in the room, which is Ukraine, and we have the government is very concerned about sort of the influence of China, and so just those two are creating a series of updates to FinCEN rules that require looking at who is investing and the structure through which it's investing. I had an experience where there was an investor, sort of a holding company, and it was in a prior job, but the Chinese army, the Red Army, was an investor through that structure. And there are several sanctions against members of the Chinese army, so that we actually had to stop someone from participating or opening an account in that case. And we have to do this through the CDD process. So you have to be very careful. If you don't know the investor, I suggest very strongly that you do a very deep sanctions review to make sure, and CDD process to make sure that you understand the holding company structure and who are the people behind the investment.
Yeah, that's a good point. And I former life was a regulatory compliance consultant and conducted many compliance trainings, and you always lead with fear. Maybe you can talk to, and this question comes up fairly frequently. What is the risk? Okay, we've got the pressure from the banks to have a process in place. Oops, this LP is associated with a sanctioned individual or entity. What is the risk to the fund?
So the risk,
liquidation of assets, frozen assets. Maybe you can just speak to the tangible risk associated with the sanctions piece of the puzzle.
Well, theoretically, FinCEN can sort of start enforcement action against anyone, right? That is clear. But it is very unlikely. My experience is that it's very unlikely that FinCEN is going to start a sanctions, an enforcement action against funds, especially if they're not very big front page type fund organizations, right? So, but the real risk is the contractual relationship that you have with the bank, because what I have seen banks do is, if the bank feels that they're too much at risk or that you're presenting too much risk to them, the first thing they do is they send the audit team. But the second thing they do is they basically stop processing your activity, which could then leave you in a lurch, put you in a lurch. And then because you have a need to use the bank to transfer money, you have a need to use the bank to transfer assets. And if the bank feels that your organization is presenting too much risk, and because of that they're not willing to provide those services, then it's going to create a real huge operational risk for your organization, and therefore you're not going to be able to serve your clients. I think that is actually the biggest risk. The biggest risk is that the bank stop working with you. I think if you're Fidelity, the biggest risk is FinCEN. But if you're less, smaller size than Fidelity, I mean, I think the biggest risk is really the bank. The bank stop. The bank's not serving you anymore.
Right. And so obviously not an outcome any fund manager wants. So practically speaking, and circling back to this, there's a hit that isn't a false positive, whether it's adverse media, OFAC check, any of the above. And maybe Justis, maybe you can take this one. Yeah. How should a fund manager be handling that, practically speaking?
Yeah. So I guess it depends on the nature of the hit, Molly. And in certain cases, it's pretty black and white. If you think you have a true positive for a sanctioned individual on, say, an OFAC, on the OFAC list or the EUML, whatever list they have, then you probably need to say that you can't do business with that person. And in the case that they're already in your fund and they become sanctioned or something like that, then you probably have to take some sort of remediation action, such as like freezing their assets in an interest-bearing account or something like that. If it's, I guess to go to another example, if there was a sanctions hit on, say, the Belarusian government, or even at this point, the Russian government's list that they keep, you might decide, and of course, speaking with your own counsel, that that's not actually a risk to your firm because a lot of those sanctions are retaliatory in nature. And then another good example is let's say that you had like the subsidiary of a regulated financial institution investing in your fund. Pretty much any hit for that, you might possibly disregard as not being a problem because that entity itself is regulated by a government. And then, there's other types of hits as well. Political exposure. You might say, okay, well, somebody who's a second cousin of a person who's like on the city council of some county in Illinois, it's probably not the biggest issue in the world, but if it's the nephew of Joe Biden, you might have a different approach. The whole sort of thing that I'm trying to paint is that in certain cases it's relatively black and white. In certain other cases, a risk-based approach is really appropriate. But the reality in both situations is that when you have a hit, you should be reviewing the contents of the hit and familiarizing yourself as much as possible with what caused it to show up, and also maybe even reaching out to the investor for an explanation. I know that I've seen certain checklists will proactively ask investors if they're politically exposed, and then if they are, please describe the nature of that exposure. They may also then run a secondary check to sort of verify what the investor is saying, but yeah.
Got it, thanks. And how about for you have hits that come up and you don't have enough information to determine whether or not it is a true or false positive? Any practical tips that you've seen in terms of the analysis associated with those potentially false positives?
Yeah, I would rely, at that point, I'd rely on two things. I'd rely on Google. Google is probably your best friend in that case. Can you find the same hit by Google searching and seeing and either verifying through like a combination of data points, name and birthday and photo ID, things like that, to see that they're the same person? If that doesn't return any or yield any sort of result, then probably talking with the investor is a good place to start, especially if your investors are mostly domestic. In the case that they're foreign, A, that might not be practical, and B, it might not be helpful. And so at that point, I would probably be talking with my legal counsel to evaluate the contents of the alert. Do you have anything to add there, Julius or Ricardo?
No, I think you're right. There's a certain amount of common sense that you have to apply. I mean, when I was doing more of when I was more involved in individual sanctions applications, there was a case of someone called Fidel Castro who was in Iowa, and that person usually used to come up all the time in the sanctions hits. And the fact is that we were able to identify that person lived in Iowa, and the Fidel Castro we were concerned about was still living in Cuba at that point. So common sense says, these are not the same person. You can clear that hit. And that's just a very exaggerated way of saying, look at the passport, look at the driver's license, look at whatever information. Google is a great tool, and you will figure out whether this person is the person who's the target of the sanctions list. Ricardo, you agree with that? You see these all the time, so.
Yes, of course. I think the only thing that I would add to this is try to always have like a multi-factor approach in order to deal with potential matches. And if Google is a tool that you use to find that last factor that you need in order to make a decision on a specific potential match, I believe that that's the way to go. But yeah, it's a very specific process of making decisions that usually you will have to create an internal system in order to make these risk-based approach decisions.
And then also, just to add to what Ricardo said, document the act of doing that, right?
Yes.
Document that you went to Google and you ran this other search, because you'd like to be able to furnish that in the future if you're asked about it.
That's really important, because the way banks usually enforce their compliance obligations is through audits. And they get the pressure from the OCC or from the Fed, and now they need to do an audit just to make sure that they satisfy the concerns that the Fed may have relative to risk. And if you have things documented, then it becomes a question of whether you exercise good judgment or not, and not whether you actually did anything, which is the absence of documentation is interpreted to mean that you did absolutely nothing.
Thank you. Incredibly helpful. We are about 15 minutes from the end here. We have a couple questions. Please submit more questions if you have them. I'll get to these ones now, and we've got a bit more content we can provide, but please do submit questions to the extent you have them, whether broad or specific. This one is a little bit specific, so I'll defer to the Passthrough team as to who wants to take it. But Are there KYC AML requirement? Are the requirements the same for SPVs investing into a single asset as VC funds that are investing into many? And as a follow-up, does Passthrough offer KYC AML subdoc service for SPVs?
I'll defer to Julius on the SPV.
Yes, the answer is if the structure is a fund, yes, we provide the service. And the KYC AML requirements being the same as those for VC funds, the answer is it depends on the relationship with the bank, because the way the requirements are applied is a cascade from the obligations that the bank itself has. So if the bank applies it, the bank is going to apply it the same way to the VC funds as well as to the SPV, to the special purpose vehicle. They're going to apply it the same way. If the bank does not apply, then it's not going to apply by definition, clearly. I don't know, Justin, if that answers your question, but that's the way I see it.
And then another question, and we talked about this a little bit, but what is the best way to handle screening an LP with a very broad name? So where we're seeing a broad common name yielding hundreds of results in screenings. I think we just talked about this a little bit, but anything in particular where there is commonality in the name itself?
Sure.
Ricardo, you can take that.
So I would stick again and talk about the multi-factor approach that we need. We have multiple instances where the name could be not even close. It could be exactly the same. So we need to go ahead and search for other things that would make specifically unique identifiers that would make it different. We have date of birth, we have address. In the case of entities, we have incorporation, the place of incorporation, or we have the headquarter address, or we have directors or signatories specifically for that entity. We also have under which jurisdiction the entity is actually operating. So there's multiple things that or factors that you can zoom in on and check in order to correctly cross-reference other factors that are not only the name.
The name is, Molly, the name is notoriously bad, especially names that are not in English, because the sanctions list are drafted very poorly in a way that actually includes various ways of pronouncing the same name. And so Ricardo is absolutely correct. If you don't have a multi-factor approach, you're going to be rejecting just far too many people. So that's not the right approach.
It's also where having a robust KYC process whereby you're collecting the adequate information from those investors from the outset can eliminate some of those follow-ups that you're then having to have with LPs to say, you know, we have this hit, that hit, which can be an uncomfortable conversation to Justis's earlier point. So having the documentation at the outset can be helpful.
And not to self-promote, but that's exactly what we do, right? I mean, because we're doing it through the process of investment, and generally speaking, there are many reasons why the GP needs information. It actually enables us to see, to in fact have a lot of data or substantially more data to be able to check whether a false positive is a false positive. I mean, that's the beauty of being able to do it early on and through the fund subdoc process.
Yeah. Still, again, please submit more questions, but in the absence of additional questions, maybe Justis, that's a great lead-in for how else can Passthrough's tool help to streamline and optimize that process, practically speaking, for VC fund managers?
Yeah, I think like the way that I would think about it is if you imagined a frictionless KYC process, and no KYC process will be frictionless, but if you imagined one, you'd have a magic ball that tells you everything about this person's beneficial ownership structure before they came into your fund. And you would know exactly which documents you need to request from them. And you would send that to them way, way, way in advance. Obviously, getting to that level is probably impossible. But what our tool does is when an investor fills out their subscription document, they make it to a KYC questionnaire where they self-identify their beneficial ownership structure. And so they say the investing entity is an LLC. We ask for who the owners of that LLC are. Then they identify what kinds of things those are. And eventually you do have what would have been sort of the output of that magic ball that tells you their beneficial ownership structure. And what they get is the list of the documents that are expected of them. And they can give a partial submission up front. If they want to be really rigorous, they can do all of it at once before even signing the subscription document. The other thing that our system does is that it automatically screens all of the names of that beneficial ownership structure. So one of the sort of major pieces of manual work in a lot of this is taking that structure and going and searching in a third party. It'd be great if you didn't have to keep track of any of that. That's what our system does. It goes out and proactively grabs those matches and puts them side by side with the data that the investor submitted. And then if you wanted an even more frictionless process, we do offer a managed service where we review all of the documents and data for you. It's part of what Ricardo does in the program that Julius runs. And we actually review the matches and tell you which matches are true matches or sometimes unsure, but also not true matches. And based on the information that contained in any of those true matches, we assign a risk rating to the investor. The idea is that we want you to focus on running your fund and only involve you at the points in time where your discretion is needed. Does that make sense?
Definitely does. Can you speak to, and this came up earlier, I think, Julius, you had given us in the fear scenario where you're working with an individual LP who perhaps is not sanctioned at the time of close and later becomes sanctioned. What is the best practice, I guess, for frequency of searching? I don't think we've touched on that yet.
Justis, you want to talk about the service that we provide in terms of on a daily basis checking?
Yeah. So we have nightly screening set up. Well, we call it nightly. It's really instantaneous. The moment that a new warning is available for something that's designated as a true match, or the moment there's a new potential match available for one of your investors, our service returns that directly to the application, and then and you get an email notification. I know a lot of folks, in absence of having a way of doing this at scale and operationally on a daily basis, which may eventually become the standard, folks are doing it annually for their investors or that kind of thing. Our system just does it nightly so that you always have the information and you can act as quickly as you need to.
Yeah, thank you. We have just a few minutes left here. Maybe to close us out, if perhaps Julius, you can start. Quick hits. What advice would you give to the group here and other venture capital and private equity professionals seeking to navigate all of these complexities?
Yeah. Plan for the future. You're going to need. It's very likely that KYC AML is coming your way, and you don't want to start to try to resolve the problem in hindsight. It's not a good process to do. It's not a good way of doing things.
Makes sense. Ricardo, any from you?
I think I would stick to the same advice. Let's try to focus on complying with the regulations ahead of time, trying to be proactive and dealing with these issues, because if they're dealt in a later stage, the problematic and the complexity becomes much more, and it's much more harder to deal with all of these difficulties once the investors is in your fund and you're already closed and you have all these issues. So being proactive about this type of regulations, I think, is definitely great advice.
Let me steal from Ricardo another thing I've learned from him, which is the multi-factor approach that we are able to offer by leveraging the information we get through the subdoc process is a good way of handling what could be an overwhelming number of false positives. And Ricardo is an expert in sort of Googling things and making sure that he identifies when there is a real hit or not.
Yeah, and how about from you, Justis? I know one thing that we've talked about in the past is an avoidance of friction and in first close, particularly with new funds where, in today's fundraising environment, there's such a push towards the first close. Maybe you can speak to the avoidance of friction and how that can not be the best approach, particularly for a first fund.
Yeah, that's what I was going to talk about anyways. yeah, I would say resist the pressure not to add friction during your first close. It can be easy. And we know that for first-time fund managers or even second-time fund managers, your LP or your LPs are the most important thing to you. You're much more likely to lose an LP if you can't transact when you're trying to distribute capital to them than you are if you ask them for a photo ID on a Tuesday afternoon or something like that. And so I would say, yeah, do it pre-close and resist the pressure in sometimes awkward or difficult conversations to not request the KYC information. Don't wait to do it until later when you know that you have to. Yeah.
Great. Well, thank you all so much. This was incredibly insightful. Appreciate you for joining us. We have our next webinar session coming up in 1 week on August 9th. That will be with Strut Consulting. And we will be focused on leveraging service providers and tech stack. So more to come. Really appreciate everybody for being here. We will be circulating the recording of today's session after the event and sending you an email with that recording. So thank you again. Thank you, Julius, Ricardo, and Justis. Great to see you. Appreciate your time.
Thank you.
Thank you.
Great day.
Thank you all.
Bye.